Hello, everyone, and welcome to another Altos Trading Live strategy session with Jeff Tompkins. This is your host, Richard Van Rich, and we have Craig Ward with us here tonight in the chat. Really excited to have you guys with us here tonight. Got a lot of great information to go over. This is your first time on one of our sessions. You'll notice that your microphones are muted. That's so we can hear Jeff and I talk. If you have any questions tonight, you can put those in the Q&A box located at the bottom of your screen. If you just move your cursor around, you'll see that. We'll put it in the chat box. We'll answer those periodically and before we sign off. If you have any question about your account, access to Trade Trend, Zillion, or any of our trade alert services or anything open as far as open trade alerts, email support@altostrading.com and we'll answer those sometime tomorrow. If you have to hop off for any reason, don't worry, this is recorded and will be available in the members area later tonight and sometimes tomorrow on YouTube. If you're catching us on YouTube, please like and subscribe so you can catch more of our videos. We're putting those out every week. So before we bring on Jeff, let me just read a disclaimer. Altos Trading LLC and Trade Trend Zillion software is intended to be used as an information service for subscribers and includes opinions as to buying, selling, and various stocks and securities. However, the publishers of Altos Trading, Trade Trend Zillion software are not brokers or investment advisors and do not provide investment advice or recommendations direct to any particular subscriber or in view of the particular circumstance of any particular person. Altos Trading LLC, including its owners, do not accept responsibilities for any decisions made by subscribers using the software, and subscribers to the Trade Trend Zillion software or any of the persons who buy, sell, or hold securities should do so with caution and consult with a broker or investment advisor before doing so. All right, with that being said, let me bring on Jeff. Jeff, you there?
I am here. Welcome.
Welcome. How you doing?
Oh, pretty good. Pretty good. A lot of action today with the Fed.
Yeah, really, right?
Kind of a crazy day. Went violently in both directions. So lots going on right now in the market. So we'll talk a little bit about that tonight and keep an eye on our key levels. The ones that we've been watching leading up to this week have played out quite nicely. So we saw a rotation higher through previous resistance and now serving as support and managed to keep prices above that level this week. So especially with the Fed today. So we'll start out by mapping out our key levels. As we're doing that, we'll talk a little bit about the Fed and how that's impacting the markets. We'll look at the 36-month moving average, which we continue to rotate higher from, which is good news. And our topic for tonight is going to follow up from previous weeks, particularly last week, where we talked about selling option premium using both static and dynamic support and resistance levels. And so we're going to follow up on that with once we've entered an options trade or sold option premium when things don't go as planned and some different ways we can make adjustments to trades. This is a topic we'll continue to cover and have covered in the past, and we'll just build on that. But we'll kind of go over some basics and high level overview of why we make adjustments, when to make adjustments, what types of adjustments to use. Expiration cycles, strike prices, etc. And then if we have any time left at the end, we'll open up the ticker roundtable and wrap up with our Q&A. So it looks like we got a great group on tonight. Welcome, everybody. Tatiana, this webinar is live. You can ask questions. Feel free to put those in the chat or the Q&A box, as Richard mentioned. And we'll be happy to address those. So let's go ahead and get over to our charts and take a look at the S&P. I'm going to pull up the SPY. Well, let's see if we've got, let me check the data for the S&P. I'd rather use SPX. Still waiting on the data there. So we've got a little hiccup with our data provider that's getting worked out now. That should be resolved here in the next day or so. But I'm going to toggle over to our broker platform, go over to a daily chart. And for now, I'll just take the moving average. Well, since we've got the moving average on the chart, let me go back over to a monthly. We'll start out by looking at the monthly, the S&P, just real quickly, because as I mentioned, we've obviously in the bear market of 2022 mean reverted into our 36-month moving average, which has served as a very strong dynamic support in the second half of last year and continues to do so this year. Starting off the year in January, we had an open below the 36-month moving average. So again, each of these candles represents a month, and had a strong close the month of January and have continued to rotate higher this month. Just a week into February, of course, so we've got some time left, but being a short month, things are continuing to look bullish for February. What I really want to see here is several consecutive bullish closes above the 36-month moving average for more of a medium to longer term, confidence of a significant leg higher, from these current levels. So it's so far looking possible. We've got some, and we're really there now with some strong resistance overhead that we're going to map out here again on the daily chart. But we've broken through one of those key levels that we talked about last week, which is at 4,100. So as I said, the Fed's really driving, let's go over the daily chart here, is really driving the volatility in the market today. So we had like this kind of, we started kind of moving higher, and then Powell made some comments about, we're basically in disinflation, so inflation's starting to get reined in, and we're seeing it in it, seeing those inflation levels come down. But then at the same time, we have stronger than expected economic data in combination with that, so it's causing these intraday whipsaws. So basically, what does that mean? Well, if we keep getting strong labor market data, and or if inflation doesn't come down to the degree that they expect, or even starts to go back up, then it increases the likelihood of further rate hikes, which they're probably going to be more rate hikes regardless of that outcome. But that's kind of the psychological fear that's taking place right now in the market, and what caused us to move up today. And then we got that big sell-off again because of that anticipatory fear, and then the reversal back up with a very strong close up today, almost 1 1/3% on the S&Ps. So but you'll notice that we rotated into this 4,100 level. So that was the resistance we looked at last week. It was so crucial to break through, and sure enough, we not long after our session last week broke right through it. And let me just kind of show you where that level is relative to past pivot points in the S&Ps. So here is where we broke out, moved up into the next level of resistance at 4,200 century mark that we're going to be looking at for this week, and then rotated lower back down into 4,100, found support there yesterday and today, and finally got a move higher. So this is really just a minor retracement, about 100-point retracement. So 4,200, I'm going to zoom out of the chart here, is our next key level of resistance to get through. And if you look back further on the chart, draw our resistance line here. We've been up here, we've been at this level a number of times in the past year. And if we take a look at what happens when we came up from underneath that level, like we just have recently, and that was back in May, big sell-off. We broke through, so you can see here there was resistance that was basically kind of more of a medium-term false breakout. So we moved up into the 4,350 resistance zone, then came back down, broke it, retested. So there's our 4,200 resistance again. There it is from last week. Then going further back, when price came down from higher levels, that served as support. So this is a very strong resistance, 4,200. So that's one we're watching for this week. Can we get through it? Is it going to continue to create problems? And as far as continuation of this up move that began at the start of January, that's what we're really watching. And of course, once resistance breaks, it becomes support. So 4,100, when we met last week, was the resistance level we were really talking about. And that if we broke through, look for a move up into 4,200. We got that. We got the retracement back out down into support. It's held, and we're rotating higher back towards 4,200. So this is going to be our major level of support. So this is strong support. Okay, so we're kind of sandwiched in between this 100-point range that will likely, we'll have some answers this week. Still have 3 trading days left in the week. So I think, there's a good chance we could break out of this range. And right now it's looking, as we're rotating higher off support towards resistance, it's looking like we're going to see a continuation of the up move. But with the caveat being, again, 4,200, very strong resistance. So that's something to keep an eye on. If we look at the NASDAQ 100 ETF, the Qs, same thing. So we've got this very strong level of resistance right around 312 that we are now rotating back up into. All right, and we've got kind of a support zone here between like 295 to 300. All right, so we want to watch this support zone. We didn't quite come down into that support zone this week, but we have rotated higher off the 300 level, which is a major century mark, into resistance here. Okay, so we really want to break through 312 on the NASDAQ to NASDAQ 100 to open the door to higher prices, where we are likely to, if that occurs, encounter resistance around the 320 level. All right, so those are our major levels on the major indices. As it relates to support and resistance, let's also take a look at the VIX. So the volatility index is actually remaining, we're continuing to get prints below 20 for a rather extended period of time here, which is our resistance on the VIX. So if we see the VIX stay below 20 and the S&P and the NASDAQ break through those resistance zones, that's our indication that there's a greater likelihood of a continuation of the up move. If the VIX suddenly spikes on us, and we have now had 2 trade trend buy signals, no trigger fall through on this one. We did get one from yesterday's buy signal, but a bearish reversal. So I think there's a greater likelihood for a VIX spike right now. And if we break through 20, we could see VIX spike up into 24, 26, or higher. So if we see VIX break, conversely, if we see VIX break above 20, rather aggressively, and we see the S&P rotate lower from that 4,200 resistance level, and the NASDAQ 100 ETF, the Qs, rotate lower from that 312 resistance level, that's our indication we're going to see probably another pullback to those support levels that we mapped out. So that's our market overview for tonight and our key levels to watch for this week. So you want to keep those mapped on your chart. Yep.
Just got a text from Daniel. Daniel said everything should be good in Zillion if you want to reload it.
Oh, cool. Okay. Couldn't refresh that. So any questions, guys, on our key levels, the markets, what's going on in the markets, what's impacting the movements, anything market related you guys want me to address?
Let's see. Let's see. Some people came in a little bit late. So yeah, if you guys came in, if you can quickly touch on some of the levels you had mentioned, but
Yeah, and this is recorded, guys, so we'll get it up. If you missed anything at the start, we'll get it up in the members area tonight, so you can review the recording. But on the S&P, we're watching 4,200 as our level of resistance and 4,100 as support for this week. So a break of either of those levels with a close on the day above 4,200 or below 4,100, in combination with the VIX breaking through 20 to the upside on a break of this 4,100 support, or the VIX remaining below 20 on a break of the 4,200 resistance, is going to likely dictate where the market is headed in the near term.
people kind of asking about the VIX. You had mentioned there was like a VIX buy last week, I think. MS, what's up with that? And it's like some of you guys are fairly new. I think Tatiana, she's in here. She's new to us. We have a lot of this, how the VIX applies to what we're doing. I don't know if you spend a little time on that, what this means for some of our, because we have actually got a lot of new folks in who just signed up with Zillion.
Yeah, sure. So and we'll take a look at the Zillion gauges as well. But what we look for are VIX buys below the 20 level. But we don't want to use, just like any other tool or indicator, we don't want to use them by themselves. We want to look at them in context. So the VIX is inversely correlated to the S&P. So generally when the VIX spikes, the S&P sells off, and when the S&P is going up, the VIX is moving down. And so when the VIX is a measure of volatility, so it's 30-day volatility on the S&P 500 options. So when VIX is low, and my barometer for low is when VIX is below 20, volatility in the market's relatively low, and we tend to see the markets moving up. But that also, markets can only move up so much before there's excess, supply, and there people cover, long positions, and so by closing open long positions, or even speculative short sellers coming into the market, it can drive prices back down. And so the vulnerability for that is greater when the VIX is low. So what we look for is buy signals from our algorithm, and these are the green buy diamonds that you see here on your chart, below the 20 level. So when we see those, historically, and we can go further back, but when we get a confirmed buy signal below 20, we historically, see a VIX spike sometime within the next month or so. Often it happens very quickly. Sometimes it takes a few weeks, but we got one yesterday that was a confirmed trigger right here. Okay. So that's really what we're looking for. But again, in the context of the a support level on the S&P breaking to the downside, right? So you want to be careful, because if we just get a little spike in the VIX and all that's happening is like what we looked at over the last few days in the S&Ps, where they just were basically retracing into a support level and then rotated higher from that level. So we want to see these, this VIX spike occur with a sustained break. In other words, a close below a major support level on the S&P for confirmation. Or we want to see the VIX remain below 20, so low volatility likely translates to up moves in the S&Ps and the broader markets. And we want to see that, occurring when the major indices are breaking through resistance. Okay, but if you look back here, we're going back couple years on the VIX chart, when we get these buy signals at low levels on the VIX, in other words, at below 20, we very reliably get a fairly significant VIX spike, at least up into like the 24, 25 level shortly after. Sometimes we'll even get multiple buy signals up below 20. Okay, we've just got 2, but you can see like back here in November of 2021, we got 3 and a huge VIX spike up into the 36 level. VIX retreat, then we got another buy, big VIX spike. We got one in towards the end of March, big VIX spike. So again, I'm really looking for these levels below 20 on the VIX, and then using that information in combination with signals I get on the S&Ps and the NASDAQ. I saw that, I think Mike asked what the vol skew on the VIX looks like, and we can take a look at that.
Correct.
So like going out to like if we go out to end of February, so we're going to look at the call side because the VIX is kind of opposite of equity products, right? You tend to see more of the volatility skew on the put side of equity products with the VIX. The risk, it's inversely correlated. So we really see the strong vol skew on the call side. So if we look at implied volatility, right? And again, today the VIX closed at 1866. So we just look at like the at the money and move further out of the money. The call side, we have a really huge volatility skew. So that tells us that, market participants may be anticipating a VIX spike as well, because there's these far out of the money strikes are priced very expensively. The implied volatility, gets up above 200%. Right when you get to like a 37 VIX strike, and it wouldn't take a whole lot for us to see a spike up into the 37 level on the VIX, especially if we break like one of these major support levels on the S&P.
Since you're in there real quick, Linda's wondering if you could kind of show quickly like how you would like say put an options trade on using the VIX, like if you were to take a buy signal here on the call side.
Yeah, I've actually got one open in my live account right now that I've shared in past sessions. I set this one out. I think when I put it on, I had like 65 days till expiration. I actually ended up financing this trade by selling S&P options. So this is a free trade for me right now. I basically sold out of the money S&P premium, booked profits on that. They're inversely correlated, right? So I put this trade on by itself first. It wasn't really going anywhere, so I went and sold some far out of the money, low delta, like 7 delta S&P futures options puts, booked profits on those to pay for this vertical call debit spread on the VIX. So this is a free trade for me right now. If the VIX doesn't spike, so this is set to expire in 42 days. Again, I put this on a few weeks ago, so this is not a trade to copy by any means, because it involved number one, why am I not getting, there it is. It involved another trade, and it was put on several weeks ago at different pricing, but I shared this when I put it on, and if you guys were on that weekly session, but now it's got 42 days left. So I've got a long 24 strike and a short 29 strike. So it's I paid a debit for that. And if the VIX spikes up into like the 29-30 level, this spread can pay off really nicely. But right now it's basically a free trade for me. So I'm just letting it sit there. I've got 42 days for the VIX to spike, but right now VIX is low, it's out of the money, so it's not really doing much for me. But basically, to put that on, if we're playing a VIX spike, looking at the chart of the VIX, what I'll often do, like if we're at low levels on the VIX below 20, and I get a buy signal, trade trend buy signal, like on the Zillion platform that we're looking at here, what I might do is go ahead and put on a bull call debit spread. And I might select, like a 24, 25 delta to buy my long call. And then I'll usually do like a 5-point spread like I did here. So I bought a 24 strike and I sold a 29. So a 5-point spread. So my max profit potential is the width of the spread, right? I can make 5 points on this spread if the VIX spikes up into this 24 to 29 zone, right? So if we get up to, and you can see, and the rationale for that is historically when we get these VIX, these trade trend buy signals on the VIX at levels below 20, it's very common for us to get VIX spikes of that magnitude. And I gave it plenty of time to work out. So I really went out, I went out over a couple of months in expiration to give it time. So I had time on my side, right? So I'll typically, if I put those on, I'll go out like 50, 60 days in expiration to give the trade time to work out. And then as we're going to talk about with our topic tonight, adjusting trades, I actually made an adjustment to this, not the specific trade. I left the spread alone, but what I did is I went out and sold put premium on the S&Ps to finance what it cost me to buy this spread. Because if the S&Ps continue to go up, then this spread doesn't make money, but I'll make money on the short puts. If the S&Ps fall, the VIX is going to spike, and I can make money on this spread that and offset that when I size it correctly with my position sizing, can make more money than I make on the spread than I lose on the short put, and I can profit really in either direction. If nothing happens and the market just stands still and moves sideways, then I'm not going to make any money on this VIX call spread, but I make money on my short puts due to time decay, and it pays for the spread. So basically, I just come out at break even. So what I did is I legged into a short put to finance the cost of this vertical call spread on the VIX. A little more advanced topic, but that is an example of an adjustment. We're going to be talking about adjustments tonight.
Awesome. I say get in there, man. Everybody's excited.
Cool. So when we look at like adjusting trades, whether it's options or equities or futures or whatever, you can really make adjustments to anything, and there's different ways to do it. So we'll start out kind of by talking about like ways to adjust, why we adjust. So we can adjust like the actual structure of the trade. So I kind of like to think of it in like two baskets. Like we can adjust the structure of the trade, and we can adjust our risk or our position size, right? So we can add risk to a trade by adding to our position size. Now, I never want to do this if it exceeds my risk tolerance. So what I almost always do when I put on a trade is I don't put on the full allotment all up front. I give myself flexibility, whether I'm using margin or just putting on a pure cash trade. I give myself flexibility to add to the position if I need to in a worst case scenario. So that's one way we could do it. Like what's a basic example of that? Well, let's say like I buy 100 shares of Apple, and of course I want Apple to go, the stock to go up, but let's say that it doesn't. Let's say I buy 100 shares and the stock goes down, but let's say that I could have actually bought, based on my risk tolerance, I could have bought 200 shares of Apple. So the stock moves against me. Well, a way to make an adjustment to that is to buy the remaining 100 shares, since I allocated 200 shares, I just didn't buy them all at once, at a lower price. Right? So that's a very basic example of an adjustment, right? But we're not changing necessarily changing our outlook or changing the structure of the trade. We're still long shares of Apple. We've just added to our risk. We've added to our position size. For me, this type of adjustment is a last resort. So this is, I kind of jumped ahead, but this is step 2. I don't want to really add, I don't want to expand, we call it expanding our position. I don't want to expand my position unless I've already exhausted my options, which are going to be in step 1, which is to actually adjust the trade. So to actually adjust the structure of the trade, right? And that can be done by actually changing the trade itself. That can't really, and this is where we kind of get away from stocks. We can't really change stocks other than that we can add other vehicles, right? We can add options to a stock trade. We can sell calls. That's an example of an adjustment. We own shares of a stock. Maybe it's trading sideways or starting to move down. I can sell calls against my shares to lower my cost basis and bring in a premium. That's also an example of an adjustment where we're not adding the position or increasing risk. We're changing the structure of the trade. Okay, so that's what I'm talking about. But certainly when you get into like options, there's a lot of flexibility to change the structure of a trade. So we can change the actual initial trade itself. We can also do kind of like what I talked about with the Apple example. We can use other vehicles even to make an adjustment. And I actually just gave a real life example of what I did with my VIX call spread, right? Where I bought a VIX call spread, didn't immediately, I've been holding the spread for a few weeks. I still got 42 days until expiration. But I didn't get the VIX spike that I was looking for in the first week or two. So I went and sold premium to finance the cost of my VIX call spread, but I did it in a completely different asset. So that's also an adjustment, but not to the initial trade itself. I adjusted by using another vehicle. So this is really the first step when I make a trade adjustment is what can I tweak to the trade itself that's maybe not working, or maybe it's not that I don't think it's going to work. My forecast or my outlook hasn't necessarily changed. It just hasn't happened in a certain time horizon. So maybe like in this actual example, I want to adjust it because something in the market maybe didn't occur or changed in the near term, but it doesn't really impact my medium to longer term outlook. So I still am confident the VIX is going to spike, and I think it has a strong likelihood of spiking in the next 42 days. So I still want to hold this trade. But what I did is I sold premium to finance the cost of that call spread and pay for it, and then book the profits on that. I'm already out of that trade, and now this is a free trade for me. So that's another way to adjust. But this is really my first step, is to first look at how I can adjust the structure of the trade. If I've kind of exhausted all of my my options, to make an adjustment to the structure of the trade, then that's where I might look at adding to my position or expanding my position. Some strategies, like I'll give an example, are very difficult to adjust the structure of the trade. And so a lot of times you with those types of strategies, you'll need to, really put on low risk up front, don't over leverage, and you do need to expand the trade. An example of that often is like a credit spread. Credit spreads can be rather difficult to make adjustments to. You've got both a long and a short strike in your spread. And that creates a number of different difficulties when it comes to making an adjustment. And so one way that I'll adjust a credit spread, if it doesn't work out, is I'll put half the spread on when I initiate the trade. So let's say I can allocate 10 contracts based on my risk tolerance. I'll put on 5, right, up front. And then if the trade works out the way I had intended, great. I book my profits. And the only trade-off was I didn't make, double the profit on 10 contracts that I could have put on. But so that's a trade-off. But the benefit is if it didn't work out, I can expand my position by putting on the other half and going to 10 contracts by adding 5 if the spread moves against me. And that way, and this will become kind of more clear as we talk about premiums in the options contracts, but that way, if, I just maybe got my timing wrong and the thing like reversed on me and I was in the hole, but then it finally went back in the direction I hoped. I mean, that happens to all of us, right? We make a trade and we feel great about it, and then all of a sudden it goes the opposite direction you anticipated, and you're like, crap, I just lost. You take a loss on the trade, and then you keep watching the stock, and sure thing, like it's almost like the market's like targeting you, right? The next day, like the thing goes right back up in the direction you thought it was. Well, this is where trade expansion, can help overcome that type of scenario, because if you give yourself that flexibility, well, I can expand my trade, add to the contracts, lower my cost basis by selling more premium, for instance, at lower strikes, and giving the trade more time to play out. And so that's the beauty of options. It gives us that flexibility with a variety of expirations and strike prices to play around with. So I'll pause there and see if there are any questions, and we'll kind of look at the premiums. And so these are really the two kind of baskets that we want to start looking at, and when we think about adjusting a trade. And so that's, again, making a change to the structure of the trade, either directly to the trade itself or by adding trades from other assets, as I did in my VIX trade example, or expanding our trade by adding shares or contracts or whatever we're trading, to get to our full risk allotment. So any questions there?
There's a handful of really good questions, actually. You guys got some really good ones tonight. Here's one that's probably fairly common. A lot of people do it's covered calls. So the guy, Robbie's saying, if you sell a call on shares you own, the stock shoots up. It's going higher, above what you sold your call. What's the best way to adjust? Do you wait till expiration, or do you sell further calls out to adjust that, or what's your
Yeah, that
go-to
is a
in
really
that
good
situation?
question. There's a number of ways you can do it. That is a great question. And in fact, if you go into our YouTube channel, which is just YouTube / Altos Trading, Richard can put that in the chat for you. You can watch all of our past weekly sessions. That every Tuesday when we hold these sessions, they're recorded and posted on our YouTube channel. We actually hosted a session a while back on how to deal with just that. I really dislike covered calls, as the traditional way to do them, because of that reason, right? Because you can sell calls and then you could be doing that for a while and it's working out great, and then all of a sudden the stock shoots up and you miss out on a bunch of profits. There's actually a way to overcome that, and that's by selling a call spread. So you're both buying and selling, so you still sell your covered call, but you also buy a further out of the money call, so that if the stock shoots up, you go ahead and keep the premium from the call that you sold and get called out of your shares at that strike price. But then you have the potential to make money on your long call, your long further out of the money calls on the appreciation in the shares. So I tend to, to favor, if I own stock and I want to sell premium against it, to do it that way. But if you were just to sell a call, and so by the way, that we did a whole session on kind of how to do that. You can find that in the YouTube channel. But if you just sell a call on a stock, your real option there is to either get called out of the shares, and so you of course want to be keeping records of your progress on the amount of premium you've sold up till that point, and the appreciation in share price, and do you have a profit or not? Because if you do, you can go ahead and get called out and then re-enter the stock, buy the shares again, which again is a form of an adjustment. Another way to adjust is to roll the call premium. So if you sell calls, like on Apple, let's say, let's say like you go like 10 days out and sell, selling out of the money strike call on Apple. Like, let's say, you own 100 shares of Apple, so you sell 155 contract, you collect about $295 in premium. But then let's say Apple shoots up, right? Well, your call premium is going to increase. So you're going to, since you're short the call premium, you're going to see a paper loss on the call premium. As long as you're okay with getting called out of the shares, you still keep the premium, and the loss really is on paper. But if you want to keep the shares and continue to sell calls, again, the option would be just to actually get called out of the shares. That way you keep the call premium, even though you showed a paper loss while the contracts were open. It's only on paper, you still keep the call premium. You get called out of the shares, and then you can repurchase the stock. It may be at a higher price, obviously, if the stock went up. But if you don't want to do that and you want to keep holding the shares, you can roll your call premium out. So what that would involve is closing your short calls prior to expiration, and then going out to a further strike and selling calls, and that's called rolling. And you can roll out to the same strike, you can roll up or down, and there's a million different ways that could play out. So what I look for, and this is what I was about to get into, so it was a good segue, is I want to see I want to see an equal or greater credit, right? So if I get called out of, let's just go to this Friday's expiration. Let's say I, held the 152. Well, let's just say I held the 150 strike calls. Well, Apple's gone through those. It's trading at 154.65 on the close. Whatever I sold these calls for, I have a paper loss in my account. The 150 strike, it probably could debit out of those for like a little over $5 a contract. But if I want to hold the shares, and maybe Apple's, and this is the importance of mapping support and resistance. Maybe Apple's right up against a resistance level and may rotate back lower, right? So I'm making these decisions in the context of the technical chart analysis and support and resistance. But let's say, okay, Apple's up against a resistance level. It has a strong likelihood of rotating lower. VIX is at low levels. So market's a bit vulnerable right now. And so I think Apple might, this is all hypothetical, like Apple might rotate lower again. So I can sell those, or actually I'd buy to close those 150 strike calls. And then maybe I want to give it 17 days for that to occur. Well, I can buy to close those 150 strike calls, which were for a little over $5 a contract. And I can go out and sell the 150 strikes at a February 24th expiration for let's see, about $665 a contract at the midpoint, right? So yeah, $665 at the mid. So I book by rolling those out, I add an additional $1.65 to my premium credit, and I haven't really changed anything. All I've done is give myself more time. So if Apple does in fact come back down below 150, or even if it doesn't, even if it just comes down a bit or goes stagnant and just kind of trades around this level, time decay will help decay some of this premium as we get closer to expiration. And certainly if the stock goes back down below 150, then not only do I keep all the premium I collected when I first sold those calls, but I also get the extra $1.65 that I collected by rolling out. So we're not adding to our risk. We're just extending, and there is the risk isn't in the options with covered calls, right? It's in the stock. I'm just extending my time horizon. So that's kind of those are kind of the ways you could handle adjusting a covered call.
Let's see. Oh, good. I got a specific question and a general question. William's asking, do you ever turn losing credit spreads into, say, regular condor trades?
Yeah. And that's probably going to be one that tonight, again, we can talk about any strategy you guys want. We're kind of just giving more of a high level overview. In future sessions, we'll get into specific strategy adjustments, because there's a lot of ways. Yeah. So if you have like a credit spread, you can convert it into, a butterfly, you can convert it into an iron condor. You can adjust the mechanics of the trade. In other words, you can change the delta of the spread to favor the directional move that's going against you. That's called delta hedging. You can roll an expiration. So there's a lot of ways, and those are some of them. But yeah, that would be one way. The key with pretty much, and this is kind of the next thing, and then we'll go back to any questions. But the key, so we'll just stay on Apple. With adjusting is you generally you don't want to make an adjustment that can't either mitigate a loss, that if something happens and you want to maybe the outlook hasn't changed for the underlying security, but you want to give the trade more time to work. It either has to mitigate the loss or have a potential to produce a profit. So the good rule of thumb, like when we're making an adjustment, is look at what you're being debited versus credited. So like a simple example is like selling a put, right? Let's say we sold a 155 strike put on Apple. Well, Apple, or let's go with 160 further in the money. So we sold a 160 strike put on Apple. Well, Apple is trading below 160, and our 160 strike puts are now in the money, right? And that's what we don't want to have happen when we're short a put on a stock. So if we look at the premium here at the mid, we're at 560, right? Expired in 3 days. So let's say Apple does in fact expire below 160, right? So these remain in the money at expiration. And I want to utilize a rolling adjustment. Well, rolling simply involves buying to close the short premium, so that 160 strike, and then reselling to open it a further out expiration. But I only want to do that if I can get an equal or greater credit. Well, in this case, yeah, I could do that. We can go out to, if I were to roll today, I can go out to the 160 strikes that expire February 24th and see that I can collect 675 at the mid. So I can collect a bit of a net credit. So why is that so important? It's important, and we call this staying net cash positive. Okay, so if the stock doesn't go back up, let's just say it stays flat, right? Or it goes back up, but it doesn't get back above 160. By utilizing rolling adjustments that stay net cash positive, and again, what that means is we're collecting a greater credit than we're being debited from the adjustment. The stock doesn't have to recover back above 160 for us to achieve a profit over time. Now, we may have to do one of these adjustments more than once, but all it really requires is a drop in implied volatility. That's enough. Implied volatility is the major component of option pricing, right? Option premium. So even if the stock stays flat and doesn't move at all, implied volatility is going to come down. And the reason this works so well with selling puts is that when a security goes down in price, implied volatility goes up. And so that actually benefits this type of adjustment, because if you look at, let's just say, look at a chart of Apple, and let's add implied volatility to the chart, right? So what happens? So look, as Apple's going up back in May, June, July, implied volatility is going down. But then the stock hits resistance and sells off. What does implied volatility do? It goes up. So they're inversely correlated. So why is that good? Well, if I'm short a put, I don't want the stock to go down. I want it to go up. So if it's going down, implied volatility is going up. But that's good for my adjustment strategy, because implied volatility goes up, the premiums get more expensive, and I can roll for a greater premium. Now, after this Apple sell-off, the stock just went into a range for a while, right? For a couple months. Implied volatility came back down during this period. So the stock didn't necessarily have to get back up here but look where implied volatility ended up. Back down at lower levels. So even though the stock didn't recover, so if I had rolled a short put that was in trouble here when implied volatility was high during the sell-off, I can roll for a net credit. And even though the stock went into a sideways range for a couple months, implied volatility came back down. That allows me to capture premium on that rolling adjustment. So that's an example of like using it on a short put. But the critical take-home lesson there is that you roll for an equal or greater credit if we're going to make a rolling adjustment. We don't want to be taking debits along the way, because if things don't go accordingly, then we're just going to be basically handing money over to the market, every so often, and without a chance to get it back unless something really goes in our favor. So that's kind of an example. But I just kind of wanted to demonstrate that as we look at the premiums, and that's important information to know as we move along into other adjustments and we get into specific strategies. But I can go ahead and pass it back to you for any other questions.
Yeah, the general question I had was, let's see, how do you decide when to adjust? Is there anything for you are you proactive on it? Is it a defensive measure for you? How do you usually?
Yeah, so it depends on a number of factors. Like, and every case is different, so you can't really write like a fixed set of instructions for when to adjust, because every situation is different. But what I look at, so I look at number one, technicals, right? Let's just go ahead and pull that chart of Apple back up. Oops. Let's select all. So I looked at the technicals. So I'm using, what did we start our session out with tonight? Support and resistance. So I'm using support and resistance levels. So I typically will start with the chart, right? Well, if I wanted to, let's say like one of the questions was selling, covered calls. Well, if I sold a covered call and the stock moved up above my call strike, what am I seeing here on Apple? Major resistance. That might help me in my decision making. If this is major resistance and the stock continues to stay below it, when I reach expiration, I might want to roll those calls out at the same strike because I expect the stock to come back down. So it partly depends on the strategy too, and implied volatility. So I'm looking at implied volatility, which favors a rolling adjustment when it's high. So when IV is high, implied volatility is high, option premiums are going to be high. Therefore, it would be easier to roll for a net credit when IV is high, right? I want to do that all in one fell swoop. You do it in one transaction, ideally. It depends on the strategy too, like a covered call. Well, you can absolutely wait till the day of expiration to adjust the covered call. A short put, which is basically the synthetic of a covered call, right? It's the equivalent to owning the shares and selling calls against them. You can wait till expiration to adjust that. You can wait till the day of. There are, other considerations like assignment. So if your strike is deep in the money, the closer you get to expiration, the greater likelihood you'll take assignment of shares. But it depends on the strategy. A credit spread, again, you may want to be more aggressive with adjustments, but you can also set your own rules. Like some people will adjust if they're selling option premium, like let's say they're selling credit spreads, they'll adjust when the market moves past their short strike. Or some might wait till it moves past the entire spread. Or some might wait until a factor on the chart. I do both. So I could, by all means, wait to adjust a credit spread till the day of expiration if I'm looking at the chart and I notice that we're approaching a major support or resistance level, and it would make sense to see how that level either holds or whether it holds or breaks, right? And then make the appropriate decision for the adjustment. So I do it both in combination, and then of course take into account the strategy itself that I'm adjusting. For instance, like with stock, which again is kind of, as we started out explaining adjustments tonight, is probably, the most basic adjustment you can make is buying more shares, called dollar cost averaging at a lower price. If I were just to buy shares of a stock like Apple, maybe I get in at the absolute wrong time, like up here at 175, and then the stock tanks. Well, as part of my trade plan, before I buy the shares at 175, I'm going to allocate a certain percentage of my total risk capital, and I'm not going to put the whole thing in all at once. And then if something occurs like it did in August, September, October, I will have in my trading plan that, okay, well, I bought shares at 175. What if the stock goes down to 140? Well, it did. Then I'm going to buy more shares at 140, right? And then I've effectively, if I do that in two steps, like let's say 100 shares at 175, 100 shares at 140, then I've effectively actually bought the stock right in the middle. And there's lots of, nuances to adjusting, and that's an example of an expansion adjustment. There's lots of nuances to that. Maybe I put on a quarter of my allotment at 175, and then I put on 2 quarters at 140, and then it's kind of like shaped like a butterfly trade, right? And then I put on the other quarter if it gets down to, let's say, 120. Well, it didn't get down to 120 after I bought the shares, but now I've lowered my cost basis even more by entering 25% of my allocation where I got in at a bad time, and 50% of my allocation down at 140. So now my cost basis is more down here. And look, I would already be back up in profitable territory just by making that expansion adjustment, even though I was completely wrong on my timing because I bought shares up here. So that's a basic adjustment example of an expansion. So yeah, again, it really depends on the asset, whether you're adjusting the mechanics of the trade or expanding the position.
All right. A lot of questions in here. So I think Henry asked that question. He's wondering if you say you're coming up on the date where the covered call is expiring, would you get a better price for the stock price if it was further from the strike, meaning like for a vertical or that you were in?
I'm not sure I understand that. Say that one more time.
He's saying if you're coming up on the covered call date, wouldn't you get a better price if the stock price was further from the strike? Let's say for a vertical or a condor. I guess it's more of a statement than a question. I guess he's saying like if you're trying to adjust the trade and you're coming up on the date of expiration. Let me see if it's.
I guess I don't understand the covered
Oh,
call.
he's saying if you're rolling the trade. Okay, that's what he's saying. I missed that part in there. So he's just saying like if you're having to roll that trade. Let's see.
Oh yeah, so I think I understand. So the price doesn't matter. If you're rolling a trade, the premium doesn't matter. All that matters is you get a equal or greater credit. Because think about it, you're getting debited one price and then credited another. So the net change to your account is the difference of the debit and credit. So it doesn't matter like if, yeah, I think I understand that because it's kind of a common thing. Like people think like they're focused on like what the actual rolling price is. That doesn't matter. It doesn't matter if it's $50 or $5, because that's the debit. The credit comes when you make the full rolling adjustment and sell the premium, and you want that to be equal or greater. So think of it like your checking account, like you go back to these 160s, you're debited, $560. So you take $560 out of your account, but then you deposit $670, $75 into your account. So you have a net credit into your account. And the reason that's crucial is for that adjustment to work, you have to collect an equal or greater credit. Otherwise, whether it's premium decay, a drop in implied volatility, a reversal on the share price, the stock price back in the anticipated direction, those will benefit you, but not enough to offset the debit. So it doesn't matter what the price is, it matters that it's an equal or greater credit.
Yeah, that makes sense to him. Let's see. You got like a couple what if questions, like do you ever sell premium when IV rank is below 30?
Yeah, I mean, generally premium selling, you want to, the rule of thumb is you want to sell high premium, buy low premium. But what I really look at is volatility skew. So again, we've covered that in past weeks. You can find the recording on vol skew in our YouTube channel. But it's particularly like when I'm doing spreads, like, so if I'm doing a credit spread, I'm looking at the implied volatility, right? And the options chain. And do I have volatility skew? Well, if I'm looking at these implied volatility at the various strikes, right? Which way is skew going? Well, it's implied volatility is getting higher at lower strikes. That means there's volatility skew on the put side of the options to the downside. In other words, there's higher demand for these lower strike, this lower strike insurance. So what does that mean? If I wanted to sell a bull put credit spread on Apple, the volatility skew is not in my favor. Why? Because to do a credit spread, I have to buy, let's just say like I'm buying the 145 strike, or sorry, selling the 145 strike, right? Well, that has a implied volatility of 29.82. Then let's say I buy the 140 strike. So I'm selling the 145, buying the 140, but the 140 strike has a implied volatility of 32%. Remember, implied volatility is the main component of option pricing. So what am I doing here? I'm doing the opposite of what we want to do. Always think buy low, sell high. Well, here I'm selling low and buying high. So a bull put credit spread on Apple, the volatility skew would be against me. What about on the call side? Well, if I look at implied volatility, I've got skew as I get further out that would be working against me. But down here on the 170 strike, there's not a lot of skew, so I might be able to structure something there. But I look at the implied volatility within the options chain as well, not just of the underlying asset. But yeah, general rule of thumb is it's better to sell high implied volatility, buy low implied volatility, and that can help dictate your which strategy to use. There's actually another topic we covered a couple weeks ago, using implied volatility and skew to determine the most appropriate option strategy to select. So a lot of people will like sell. They're like, oh, well, this stock's going up, so I love credit spread, so I'm gonna sell a bull put credit spread on this stock. Well, maybe that's not the best trade to use based on volatility skew. Maybe a bear or a bull call debit spread would be more appropriate. Better risk reward, volatility skews in your favor. It's probably one of the most overlooked components of options trading. Very few retail traders understand that or do it correctly. But again, we did a session on that, I think a few weeks ago, on how to use volatility skew to help select the most appropriate option strategy based on your outlook of the underlying security.
I just wanted to reiterate to the crowd. I know we got a lot of folks on that may be new to us or new to options trading. Adjusting options trades is pretty I wouldn't say advanced, but it's definitely something that takes a little bit of experience to kind of understand. So if you're new to us, new to trading, or just options or maybe have always been over your head a little bit, we do have several options courses in the members area to kind of catch you up on the basics of it. And then as you progress into some of these more complex topics like adjusting options trades, there's several other things we've covered in past sessions that maybe aren't quite as technical as this for you. But just to understand that, each week we cover different topics, and for some of the options adjusting is maybe a touch over your head, don't worry. We do have just basic options courses that you can watch, and then obviously each week we cover different subjects. So just because some folks on here are brand new and they're like, whoa, this is.
Yeah. Well, and that's a really good point. So we do have basic stuff. You guys can watch our basic courses. And like I mentioned, our weekly sessions do kind of, somewhat build on each other. But not all of our members, of course, are able to attend every single week. So that's why we record these. So a great resource too is just to go into our YouTube channel. Again, I'll put that in here for you. So it's just YouTube. I'm going to put this in the chat for you guys. So they're all recorded. So you can go back to, last year and watch more basic sessions. So if you don't understand anything, a lot of it's explained in past weekly sessions. So that's a great place to start as well. So yeah, Tatiana, don't worry, if it's over your head, it'll sink in. And certainly, it may be a bit out of order for you, but you can go back and view our courses or watch, our past sessions in the YouTube channel as well. Yeah, Mike, I do sell out of the money puts and calls on the S&P at the same time. It's called a strangle. I do use that. I often do it with other trades, or as part of adjustments, or spreads and things like that. But yes, I do that. That's awesome, Eric. Eric said he took our put selling course on Udemy, and he went 8 for 8 on paper trading. Nice job. Good to hear. Yeah, and I go through on our put selling course. I go through all the adjustments as well there. Geez, that flew by. We're already over the hour. I just looked at the clock. Any other questions, Richard? We didn't get to take a roundtable again, but we'll leave more time next week. Next week we'll probably do more of a general session for you guys to ask questions, and open it up to take a roundtable. There's probably a lot of things you guys are watching right now with the markets, kind of at an inflection point, and with everything that's going on with interest rates and the Fed. So we'll next week probably dedicate more of the session to that. But any other final questions tonight, Richard? And again, this was really just a high level overview of adjusting. We'll get into specific strategies and adjustments and like how to set the strategy up and look at some actual hypothetical examples of, things not working out. We may even use some actual real examples from our past trades and show you how, what we did and why. And so it'll become more clear, but we have an hour together each week. We usually run over like we did tonight, but so we break it up. We don't want to throw it all at you at once, and certainly you don't want to sit here for 3 hours and have everybody's head spinning. So again, tonight was really meant to be kind of more of the high level, and we'll get more into specifics in future weeks. So and there's our contact information. If you guys have questions, support@altostrading.com. We're here to help as well. So even outside of our weekly sessions, if you guys have questions or need help with anything, we have a lot of resources to do that, from courses and you can even follow along with our services. We have a number of different options alert services that include trade adjustments as well in those. So if you're new and you're just getting started, that can be a great resource to kind of follow along as well. And you can find information on those at altostrading.com or by emailing our support@altostrading.com. So that was it, Richard. No other questions, you said, huh?
No, but we do want to let people know that since next Tuesday is going to be Valentine's Day,
Oh, right. Yep. My wife might kill me if I do if
yeah,
I'm
seriously.
not available. Same with Richards and Craig. So yeah, actually, we will be rescheduling next Tuesdays because it is Valentine's Day. Thanks for reminding me. And so we'll keep you guys posted. Just keep an eye out for the email. We'll let you know the date that we're going to reschedule to. We'll still keep it at 7 p.m. Eastern, but we'll let you know what day we reschedule that to.
And there may be a special Zillion session next week.
Yes, yeah. So we're actually holding. We have a lot of new Zillion members on with us tonight, and we use the platform a little tonight, but because we went more into option strategy, we didn't use it in depth. We are holding a dedicated Zillion session for all of our new Zillion members next Wednesday night at 7 p.m. Eastern. So that's Wednesday. Let's see, what is the date next Wednesday?
15th, probably.
Yeah, so next Wednesday we're going to be holding that the 15th at 7 p.m. Eastern. We'll send out invite instructions on how to join the Zoom session. But for all of you on tonight that just join the Zillion platform, we'll be holding that next Wednesday. And if you can't attend, we will record it and post it in the members area for you as well. But that'll be a good opportunity to dig more into the Zillion platform and give you an opportunity to ask any questions. And we'll get more into the signals and stuff next Wednesday on that. So.
Awesome. That's all I got.
All right. Well, I want to thank you guys so much for being here. Look forward to seeing all the Zillionaires next Wednesday at 7 p.m. Eastern. Again, we'll shoot out an email to you guys with the instructions on how to join that session. Thanks everybody for their great participation and questions. And we'll see you not next Tuesday. So if you're on the other side of the world getting up in the middle of the night, please don't do that. We'll keep you posted on when we reschedule. And hope you guys have a great rest of the week. We'll see you all soon.